All set? Okay, let's get going. Welcome everybody, those of you who are here around our round table, and those who are listening in. Marianne Sen and myself will go through the arguments for Swedish monetary policy against the backdrop of what's going on in the rest of the world and also in the Swedish economy. So yesterday we decided to lower the repo rate by 1/4 percentage point, so that now the repo rate is down to 1%, which is, of course, if you look back, a very low rate. And the main reason for us reaching that decision was because things have evolved a little bit worse than we expected when we sat here the last time, and that's particularly against what's going on in the rest of Europe. Not that there are any major changes or differences in Europe, but what seems to have happened, though, is that we are more affected than in the past, because so far, when various issues have been dealt with in Europe over the years, it hasn't really affected the Swedish economy all that much. But this time, as far as we can judge, it has affected not the least the sentiment. And against that background, then we decided to lower the rate in order to support demand in the Swedish economy, and at the same time, and I'll get to that later, given that the inflation rate is low, we also need to gradually get the inflation rate up to or towards our target. Now, looking at what's going on in around us, if you start with the BRIC countries, or one could just as well also have used a graph for global growth, it's sort of fairly normal. I mean, they're growing at a brisk pace if we compare to the way things are going in Europe. And this is, of course, a good thing for the Swedish economy, given that we are exporting more and more to these parts of the world. At the other end of the spectrum, as you can see here, the EMU area, the euro area, is going to shrink a little bit next year, so that will be a bad year in that part of the world, and that, of course, affects us. The U.S. is growing reasonably well. They deal with a number of issues when it comes to the fiscal cliff, labor market issues, and so on and so forth. But this is done on the assumption that they'll figure out how to deal with the fiscal cliff in such a way that eventually, at the end of the day, despite the noise, there is no major drama when it comes to fiscal policy. And when you add all things up, in terms of the KIX index, which is a trade-weighted index, here expressed in growth terms, that's what really matters to us. And there you see that you have a growth graph which is somewhere around 2%, which is, of course, then in line with our own projections for the Swedish economy. But again, as I started out saying, this implies that we have weak demand for Swedish exports. Here you have exports orders measured in two different ways. And it's below normal. These graphs look a little bit like the graphs in the beginning of the 2000s. So in that sense, and this is also the way I've explained it earlier today, we see this more as a kind of a normal, if I call it that, recession. We're not talking about 2008 and 2009, because then we had very different circumstances. But again, this is what sentiment looks like, and that will, of course, then affect confidence in the Swedish economy, both on the corporate side and among households. Because if you look at the red graph and the blue graph here, you can see that the confidence indicators are on the low side. But again, they're actually fairly similar to what they look like, let's say, around 2002 to 2004. And all of this taken together will dampen Swedish growth in the year ahead. The issue that we have struggled with in the past year or so is that growth actually came in higher than we expected, and many others as well. While on the other hand, the issue is then what will happen to growth this quarter and next quarter. But then basically, given that all of this is done on the assumption that growth will come back in the rest of the world, particularly in the euro area, things will normalize or start normalizing towards the end of 2013. And as you can see here, when it comes to our projection, it's actually towards the end of the period, very similar to what we had in the monetary policy report some months back. But given that this is where we are, there are signs of a weaker development in the labor market. Here, if you look at this graph showing, so that I get this right now. So showing planned layoffs, you can see that these layoffs actually, the planned layoffs go up and down quite substantially. They're at much higher than in the past, but we're not at the same level as 2008 and 2009. So in that sense, this time it seems to be different. One also need to be mindful of the fact, and Marianne will go into some of the details when it comes to all of this, that actually most of the layoffs or the planned layoffs do not really turn into unemployment over time. So these this measure shows where we are heading, but still the magnitude is not sort of a one-to-one mapping into unemployment. But nonetheless, when you do the unemployment projection that we have done, we expect unemployment to start rising and peak towards the end of next year, and then unemployment, given that everything else normalizes, will gradually come back and fall down towards 6.5–7% in due course. And of course, as you can see here, this is an upward revision compared to what we had a couple of months ago. Now, inflationary pressures are low presently. Comes from a number of factors. One is the fact that the krona depreciated in the past, and that of course means that on the import side, price pressure is low. Secondly, wage increases have been very, very modest in the past. That also has an effect here. And then, given that we started lowering the repo rate about a year ago, that's picked up by the CPI, and then you get sort of that extra part of it. So for these reasons, CPI will be hovering around 0 for the next year to come. On the other hand, taking out interest rate changes, you can see that the inflation rate is around 1%, and then when aggregate demand gradually picks up according to our projections, then in CPIF will gradually move towards 2 again. And of course, given the way we calculate CPI, when the repo rate starts going up and other rates go up as well, particularly rates on mortgages, then CPI will overshoot towards the end of the period. So it's a pattern which is very similar to patterns that we have seen before. The important issues that we have been struggling with in terms of what to make of it when it comes to the projection and turning all of this into Swedish monetary policies is the following issues. There are still major challenges in the euro area that many countries in the euro area have to deal with. There is a sequence of structural change that will have to take place in various parts of Europe, and that sequence of structural change is what a number of countries are struggling with, and that creates all sorts of issues on the fiscal side, within the labor market, and many other issues that countries have to deal with. But here, one should be, I think, also mindful of the fact that I do think that, for example, Spain and Ireland are heading towards current account balance, or maybe in the future even a surplus, and that is a sign that despite all the arguments and all the discussions going on, part of that structural change is already taking place. And also, if you look at the countries around us, our Baltic neighbors have pretty much gone through this process already. So it is not that structural change is not doable. It can happen, it will happen, and part of it is on its way. But then there is a kind of a flow aspect of this, and the flow aspect is that the pace of this change is not the same for all countries in Europe. All of this, when it comes to Swedish sentiment, has translated into a weakening of the labor market. And as I mentioned, the rate of inflation has declined, and that's, given our inflation target, is then of course an issue for us. And then the risks concerning high indebtedness in the household sector, those risks remain. and they are here to stay, given that the debt-to-income level is high in this country compared to many other other countries. And that means that at least in the near future, this issue is not going to go away. Well, on the other hand, our projection this time is that the debt level will be stable, almost stable over the horizon that we're talking about here. But then let's hope that it also stays that way. So turning this into monetary policy, first of all, let me start by saying that monetary policy for many years has been done or executed on the assumption that there is a kind of a normal level of the repo rate, somewhere around 4%. And that was the assumption that we have used all the time. After 08 and 09, when better times returned, it was natural for us to make the assumption that gradually the repo rate would move up towards 4% again. Now, what happened this time around, though, was that the recession came much earlier than many, including us, expected. So we ended up with a repo rate that peaked at 2%, and then we have half the rate in the course of this year. And then that, of course, brings us to a scenario which is quite different from quick normalization, if I call it that. But this time, as always, we make the assumption that things will normalize and we'll work our way towards a 4% repo rate. But as you can see from here, it will take a number of years before we get there. And now our baseline assumption here is that we'll stay at around 1% for the coming year. But as always, it's a forecast, it's not a promise. And if really unforeseen things were to happen in Europe, then we would have to factor that into our thinking, and then that most likely would mean that we would...
Are you there? If you wish to remain in conference, please press any key now.
That means that we would end up with a lower rate than what we have presently. But on the other hand, if you look at it the other way around in terms of what's happening on the growth side, if the rest of the world, except Europe, grows in such a way that it kind of drags Europe with it, then we actually could end up with a better scenario in the sense that the turnaround comes quicker than we have expected. And if that happens, then of course aggregate demand will be higher, exports will go up, and inflationary pressures will go up sooner rather than later, and then that would lead to a policy rate also going up sooner rather than later. But nonetheless, staying at around where we are for the coming year, that's our assumption as of now. But it's a forecast, as I said. It's not a promise. Mm-hmm. And now Marianne will go into some of the details, starting off with the graph that I showed you on layoffs.
So this is the same graph again, and there's been quite a lot of talk about the increase in layoffs recently, and this is indeed a worrisome sign that we need to take into consideration when making our forecast, and which we of course have. This same graph can be expressed in a slightly different way. So these are layoffs during 5 years, 2008, 2009, 2010, 11, and 12. One line for each year, and it's accumulated figures from the beginning of the year. And if you start looking at the red line, that's the development so far this year. So if you see the last observation in November, that tells you that so far this year there have been 66,000 layoffs, or layoff notices in the Swedish economy. There are 2 points about this graph. First of all, this year looks worse than the 2 previous years. So the red line is above the red and the yellow and the blue, which are 2010 and 11. So we have things are looking worse this year compared to the 2 previous years. That's the first point. The second point, though, is that this is not at all as bad as it was in 2009, in particular. The gray line, and also during the fall, not as bad as in the fall of 2008. There have been some parallels made between the fall of 2008 and what's happened this fall. But as you can see, sort of from the slope of the green line, there the layoffs increased at a very, very rapid pace. If you compare that to the red line, you can see that the layoffs have not increased at all as rapidly as they did during 2008. But still, you can see this is, of course, a clear sign that the labor market is weakening. But when studying these layoffs and thinking about how it affects unemployment, there are some more things that must be kept in mind. First of all, these are layoff notices, and not all layoff notices result in actual layoffs. And of those who are laid off, not all people become unemployed. And that's what this graph shows. So this shows the proportion of people who were actually laid off and who 6 and 9 months later were actually unemployed. So this is the employment service that does this kind of study. So what they did, for example, the very, very last observation in that red line it's a study at the end of 2011. They looked at a group of people who had been laid off 6 months earlier, and they looked at how many of these are actually unemployed today. 15%. And of those who were laid off 9 months earlier, 20% were unemployed. And that has been done all the way back to 2005. And there you can see that this is a proportion that varies over time. In particular, during the financial crisis, this hit 45%. But there seems to be some kind of average around 20%, say. So fortunately, of those who are given notices, not all are actually laid off, and of those who are laid off, fortunately, not all become unemployed. And that's the first point here. Only a fraction of layoff notices actually lead to unemployment. Another point, which I don't show in a graph here, is that it's only a small of the inflow to aggregate unemployment, only a fraction is explained by layoffs. This tells us that we need to look at more information than layoffs when making our unemployment forecasts. And that, of course, we do. But layoffs are an important indicator, but we look at lots of indicators when making our short-term and long-term labor market forecasts. So all in all, that results in this updated unemployment forecast, where unfortunately we see unemployment peaking at a higher figure than we previously thought. So 8.2% in the third quarter of 2013.
So then, this is where we are at 1%, thinking that that's a good thing for the Swedish economy and for next year, given the fact that it has taken longer in Europe to sort out the various issues going on in Europe. I think, but having said that, fortunately, the rest of the world is actually reasonably okay, and that's a good thing. That's a good thing in itself, and that also speaks in favor of a relatively mild downturn and nothing that similar to 2008 and 2009. That's our assumption when it comes to monetary policy here. So, questions, reflections on this?
The conference has been unmuted.
So you put in 4 BPs lower rate path in your going forward. I just wonder what was the reasoning behind it. Is it just to show that you think that it's a bigger probability for another cut than for a hike in near term, or what was your reasoning?
That's the way it has. That's the way it has been drawn. Then, given the way these things seem to work when it comes to moving from one decision-making point to another in the course of the, let's say, 6 to 9 months, people tend to get out both the magnifying glass and the ruler when they look at these things. But given that we're talking about averages over quarters, It's just an indication of what the probabilities. It's nothing more than that.
But I mean, usually, or at least several times this last year, you have had a repo path exactly at the point where you are now. So you must have thought about at least sending a small signal, or what's the point?
Well, there is one technical interpretation, and that there's a higher probability of a lower repo rate than of a higher repo rate in February. But the most likely outcome is an unchanged interest rate.
It's not fancier than that, so there are no hidden, hard to find signals in this. Yeah.
I have a question regarding Marianne's presentation, the part of the labor market here. It seems that you have taken your study about the notice of layoffs into consideration. Your unemployment forecast is a little bit upward, yes. But taking into account the recent data from Labour Force Survey, even if I know that and admit that the monthly figures are very volatile, still the seasonally adjusted unemployment level in November was 8.1%, and we also observed that calendar adjusted working hours was down by more than 1% year on year. In what aspect have you taken the November LFS into your forecast?
Well, as you said, these monthly figures are very volatile. If we go back to October, that same figure was 7.7, and then in November it was 8.1, and December, well, we'll see. That remains to be determined. But we did our calculations, and we thought that this November outcome, 8.1, was compatible with our Q4 forecast of 7.9. So, but as you said, I mean, they're extremely volatile, these monthly figures. So we tend to smooth it out by looking at the quarterly figures. So the latest outcome is we've taken that into our forecast.
You also talked about 4%, coming back to 4%, even though it's in a distant future right now. Do you still think that 4% is reasonable given maybe a new environment going forward?
It depends on what means about the future. No, it's the hard part is, of course, what other assumption than to make, because if you start moving around these parts, then you would have to come up with a whole new set of assumptions in terms of the policy rate, the growth rates, all sorts of other things that go into these models, and we have no ground for, at least as of yet, for changing anything. There are two parts to this. One is how to think about the future in terms of, is it just going to repeat itself, or is there a different future in terms of another combination of variables producing a future equilibrium, whatever that means. So that's one set of issues. Another set of issues, which you see very clearly when you look at all the graphs that we've gone through a few minutes back, is that you get the impression that the world is more volatile in the past 5 years compared to 6, 7, 8 years before that. And we even used the term the Great Moderation, thinking that everything would be stable. But that wasn't quite the case, and that of course means that in this environment it's just harder to make projections. It's just harder to judge where things will be going. And we do know from experience, and if you look at the numbers on the fan charts, that let's say 1 to a year and a half out, the predictive powers are sort of reasonable, but if you go beyond that, then uncertainty increases quite rapidly. That doesn't change the equilibrium assumptions, but that of course means that the likelihood of you ending up close to the mean is increasingly dim. And essentially, if you look at the fan charts and the way they are drawn, basically what they do is a very, very simple thing. They catch all the observed data that we have seen in the past 10 years. And then you have the maximum and the minimum and everything in between. And the flatter the probability distribution you get, the more you basically say that the likelihood of each and individual event is the same as the likelihood of all the other ones, and that's just another way of saying it's a nicer statistical way of saying it's hard to know. But that's the same for everybody, so there's no difference for us and others.
Yes. Can I ask what's going to be the turning point? And they usually say that time is the healer. So if you just give it time, it'll fix itself. But the charts you've shown, you've seen new orders for companies are very low. So they are, I guess, very unlikely to make investments, and that's why you've seen some of the layoffs. And this will also push on to the low wage increase that you also spoke about in the report. This is all very negative for inflation, of course. But is it just as time goes, there will need to be like reparation investments, just because?
Yeah, eventually, if you look at the rest of Europe, that will come, and one should be mindful of the fact that in a good number of Europe, good number of countries in Europe, they've struggled with this already for 5 years. And that means that we also know from experience that also in the kind of do nothing case, eventually you get a turnaround, because the capital stock starts to shrink, it gets too old, and people just get tired of bad times and say, okay, things will eventually improve, and then they start shopping again and start investing again. And this process has been going on now for quite some time. And if you combine that with the rest of the world not looking so bad, which is very important for us, it's very important also, and will be important, let's say, for German exports, then that is very helpful, very helpful.
You mentioned risk associated with high indebtedness among the 4 factors. I wonder, how do you incorporate a possibly higher risk weights into your thinking on monetary policies? The interaction there, does it make it easier for you to stimulate or target other parts of the economy? Or?
No, actually, we and probably many with us have some homework to do on that side, because if you think about monetary policy in terms of let's say in our case, the repo rate, and then you to that add an interest rate margin, and that's basically how you define the transmission mechanism. And then that eventually defines the cost of money for corporates and households. And the more you do on the margin side, the more you have to try as best as you can to incorporate that in your thinking when you think about monetary policy, and that makes things more difficult to do. We have one good example this time it's a sort of a tiny detail. I said that CPI has been coming down because we lowered the repo rate, but CPI has also actually been coming down because the interest rate margin went down a bit lately. And if you think about or just reflect on a traditional conversation about the CPI, it's usually about rubber boots, tomatoes, electricity prices, whatnot. But it's extremely rare to have somebody start talking about CPI in terms of the interest rate margin on mortgages, saying that was the thing that really changed this time. And we just have to get used to that. Now, so far, we haven't really done much on that side when it comes to what has happened in this country. It's more talking about it, but we are heading in a direction where, for example, when you start working using countercyclical capital charges, we will have to define where we are in the cycle using that metric in the future. And that we haven't done in the past. So we certainly have some homework there to do. And one tiny detail this time, which we have never done before, is that we have a graph with our debt projection for the households in the report this time, and that we haven't had before. So it's a short graph. The dotted line is short, and it doesn't change very much. But still, it tells you something about the direction in which we are moving, and what we will have to start dealing with more extensively in the future. That won't make things easier, because essentially it just means that we'll have even more moving parts than in the past keep track of, but we still have to do it and do as best as we can when it comes to trying to factor that into our projections. But it's hard to do. It's hard to do.
If you go back 5 years or so, I mean, we made our forecasts sort of conditional on the assumption that regulations and the financial sector were pretty stationary, spreads were pretty stationary, and I think we learned a lot from the financial crisis, namely that these things are not stationary, they can change quite dramatically, and they change the impact of monetary policy and the transmission of monetary policy. So that's what we've been working on the last couple of years here in the House and in lots of other places. Anyone who makes forecasts, you too, have to take the changing financial environment into consideration. So it's not an easy task, but we're working on it.
A question connected to that again is the household sector and your forecast regarding household consumption. We can observe that you have decreased the private consumption forecast both for this year and also for next year. Is that perhaps one factor that you are a little bit less worried about, that the household sector will really want to take on more debt and that they will be more careful because we have seen consumer confidence is a little bit downbeat, and as I said, you have decreased your private consumption forecast. Is that one factor you take into consideration here?
Is it a question about the forecast or about how it's been assessed in the monetary
the
policy?
The household sector behavior, you have reduced the consumption forecast. Is that also affecting your view about the household willingness to take on more debt?
I mean, that's one part of this picture and these projections here. But when it comes into how this has affected the monetary policy decision, that's not for me to say. Really, I mean, that's the executive board. They make these
No, I mean,
assessments.
I mean, basically, what this graph is saying is that we're going through a period with slow growth. Households are more gloomier than they've been in the past, and eventually, when you come up with a projection for debt, then that's likely to also affect borrowing, which is a good thing in itself. But then, making these projections, it's hard to do. It's hard to do, but this is sort of the general idea.
Can I ask about something you discussed a couple of years ago? Was that what is the 25 basis points change at these nominal levels?
Are you there? If you wish to remain in conference, please press
sorry.
the key now.
Once again.
Does the rate change have the same effect at these levels, nominal levels of interest rates, than if we were at 7% or 5%? I know we're not really super close to a zero lower bound yet, but is there a difference in consideration when you change interest rate levels?
Not in the sense that I'm glad that you raised this point, because if you look at, let's say, what's going on in Europe, our assumption is not that our transmission mechanism is impaired. That makes quite a difference when you look at the level of interest rate that you are talking about. Because you can actually, if you have concluded, or if you were to conclude that the transmission mechanism in one way or the other is impaired, because it doesn't matter what you do with the rate, banks don't lend anyway, well, then the same nominal policy rate can mean a completely different thing. And that's why they in Europe are struggling with all these other types of loan programs, recapitalizing banks, banking union, and all the rest of it. Because if you have all those issues to deal with, then you really have to think hard about how to reestablish or how to normalize the transmission mechanism. But luckily, we haven't had those issues at all, because I mean, our credit losses are very close to zero. The banks are well capitalized compared to most other banks. So and our balance sheet, if you put aside our increasing our FX reserves, is completely normalized in several years back. So we are kind of at where we want to be, and we look at it the way we have looked at it in the past. But there's one difference though, and and Marianne alluded to that as well. We spend much more time today looking at the details of, let's say, interest rate margins and things like that that happened in the past. But then, having said that, it's not hard. It's hard to fully understand, let's say, from one month to the next month, why the margins are going up and down for a whole bunch of different different reasons. But still, if you look at the overall picture, asking yourself whether kroner-denominated interest rates follow the interest rate, our policy rate, the answer is yes, they do.
Now we have a graph of that in case you forgot. Yeah. The correlation is very, very high.
Which is, of course, not always the way it is perceived, because in the daily discussion, then you always find individuals or individual banks or other financial institutions where this doesn't hold one-to-one, but eventually it holds together, and it does hold together actually quite well.
You have earlier complained about the lack of measures in other parts of societies to handle household debt. Do you feel the same way today, or?
Yes, that remains.
You haven't seen any?
No.
No.
And that's an issue, and that will remain an issue for the foreseeable future. And this is serious. It's a serious issue, because if the legal structure is such that our job is to talk about these things and nothing else happen elsewhere, then eventually we'll have a problem. Okay, no more questions, reflections? There was one? Yeah. Two more? Okay.
At the start of your presentation, you compared with the early 2000 downturn. Two observations from me. The first one is that we started from a lower point now regarding economic activity. That's more free resources. That's one thing. And the other thing is going back to the labor market. At the earlier, we can now see a higher level of long-term unemployment, and we have to remember also that still in the beginning of the early 2000s, we have a lot of people were early retired due to the generous pension system. Today we have a much more harder system here, so that's two important difference. Can you evolve that?
Yeah, one of the issues here, and unfortunately this graph starts at 2006. If you were to go, let's say, all the way back to the 80s, then
I can find it.
And it's in here someplace.
There.
Here, starting 85. The worry of ours and many others is, of course, whether the average is trending up. Because here you can see how unemployment has moved up and down, but this time the trough came at a higher level than twice in the past. And if it remains that way, then that, of course, is an issue. And when it comes to matching and labor market matching, we have discussed this and came to the conclusion that matching has worsened. And if there are structural issues there, then that's an issue for the economy as a whole. We can't manage that. We don't deal with that when it comes to from a monetary policy perspective. But then, of course, it would be very, very unfortunate if unemployment just, if there is some kind of, I don't know what to call it, ratchet effect. That means that we, over the years, end up at a high level, and that's a serious issue. That's a very, very serious issue. But I just can't see how monetary policy 100% could compensate for that.
My question relates to that, actually. Of course, monetary policy can't fix all of that. But you have talked a lot about matching problems and so, sort of indicated that there could be a structural issue. Don't you think that it's too early to tell? Don't you think there's a risk combined with just making it a structural issue right now when we've had large reforms in the labor market, increasing the labor force, and since then we've had two dips in the economy, and between them we didn't even reach sort of like a zero gap, or what do you call it, like equilibrium in some sense.
Well,
Don't you think that it's too early to just say that it's a structural problem?
there is a structural issue there, while at the same time, this is exactly why we say when you talk about a level of stable unemployment, if I call it that, our preference is not to come up with a fixed number, because these things are just plainly hard to measure, and they move around. They move around over time, and that's why we talk about an interval between what is it now, 5.5 to 7.5.
That's
roughly.
correct. Yeah.
But where we are in that interval, or what the distance is from that interval, if you look at today's situation,
I'm just saying that since these reforms came more or less since 2006, and we sort of haven't had, we've only had downturns since then, more or less. It could be difficult to now say what portion of this matching is cyclical and what is structural.
If I may, I mean these are really difficult issues, and the executive, but on at least 2 occasions, the executive board has lowered the repo rate, referring to exactly what you're talking about to developments in the labor market. So I mean in September and in particularly in October, when the path was revised explicitly, it was to the worsening state of the of unemployment and the labor market. So I mean, this is something that's definitely taken into consideration when monetary policy is designed. So it's not like it's something, it's entirely exogenous.
Okay, thank you for coming, and thank you for coming all the other times in the course of this this year,
Okay.
and all the best for the
Christmas. Yeah.
upcoming holidays, and
Okay.
have a happy New Year as well.
Okay.
Thank you.
Thank you.